Hello everyone, I'm Twinkle Jain and today we are going to talk about something that often gets overlooked when investing in mutual funds, fees and charges. Understanding the cost of investing is just as important as understanding the potential returns. So, let's break down the different types of fees you might encounter and how they can impact your investments. Let's start with the expense ratio. Think of the expense ratio as the management fee you pay for the services provided by the mutual fund. This fee covers everything from the fund manager's salary to administrative costs, marketing expenses, and other operational costs. The expense ratio is expressed as a percentage of your total investment. For example, if a fund's expense ratio is 1.5% and you've invested 1 lakh rupees, you're paying 1500 rupees annually as a fee. Now, you might wonder, is 1.5% a lot? Well, it might not seem like much at first glance, but over time, this seemingly small percentage can significantly impact your returns. For instance, let's say you're investing 10,000 rupees per month for 20 years with a 1.5% expense ratio. You could end up paying nearly 6.5 lakh rupees in fees alone. That's a substantial amount that could have been invested or earned interest, which is why it's crucial to understand and compare expense ratios before investing. Next up is the exit load. Imagine you've taken a streaming service, but you decide to cancel your subscription early. Most services will charge you a cancellation fee. Similarly, an exit load is a fee charged if you decide to redeem your mutual fund units before a specified period, usually 1 year. The exit load can range from 0.5% to 1% of the redemption amount. For example, if you redeem 1 lakh rupees within the first year and exit load is 1%, you will pay 1000 rupees as a fee. Why does this matter? Well, if you need quick liquidity or are planning to withdraw your investment within a short period, the exit load can eat into your returns. So, always check the exit load before investing, especially if you think you might need to access your money sooner. Then there are transaction charges. Transaction charge of around 100 rupees is payable in 4 equal installments when your investment in SIP crosses the 10,000 rupee mark. This is a one-time charge. Now, let's talk about the tax implications. Mutual funds are subject to capital gains tax depending on the holding period and the type of fund. For equity mutual funds, if you hold the investment for more than a year, you qualify for long-term capital gains tax, which is 12.5% on gains exceeding 1.25 lakh rupees per annum. If you sell within a year, short-term capital gains tax applies at a rate of 20%. All these fees and taxes should be considered because they directly impact your net returns. The higher the fees, the lower your overall returns, which could delay you in reaching your financial goals. That's why it's crucial to be informed and choose funds with lower fees, especially if you're investing for the long term. Remember, every rupee you save on fees is a rupee that you can grow and compound over time. That's all for today. I hope you found this insightful. Keep a lookout on this space for more such content. This is Twinkle Jain helping you make smarter investment decisions every day.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.